Hey, what's going on everyone? My name is Aaron. In today's video, we're going to be talking about the hidden dangers within your investment portfolio. We're going to start off by talking about stock overlap. We're then going to talk about the importance of understanding why you own a particular investment. And lastly, we're going to talk about yourself and how you can be one of the biggest dangers to your investment performance. I'm also going to be sharing with you 3 tips you can implement right now to help strengthen your overall investment portfolio. If that sounds interesting, please leave a like on the video, subscribe to the channel. We got a great show for you today, so let's get right into it. Alright, so starting off number 1, stock overlap. So one of the most common mantras preached today within the investment community is the use of low-cost index funds to grant the everyday investor broad market exposure to the general overall markets. So to do this, people typically use ETFs or exchange-traded funds. So an ETF is essentially a bunch of stocks that have been put together in almost like a basket, and that basket makes up an investment fund, which then can be traded as a normal stock would be. So there are many different ETFs, all of which track different things. You have the S&P 500, which tracks the top 500 US companies. You also have total stock market ETFs, which are essentially almost every single stock in the entire stock market lumped together in a single ETF. You also have international ETFs, which grant you exposure to different stocks all over the world. So the diversity that these funds offer are fantastic, but the problem posed is that most people typically don't actually look to see what the different holdings are within those particular ETFs. So this poses the first danger for today's video, which is this idea of stock overlap within the different ETFs you may own. Okay, so to understand what we mean by stock overlap, let's take a look at a basic ETF which tracks the S&P 500. Now, while it's true that this particular ETF, VOO, tracks the top 500 US companies, if you look closely at the portfolio's holdings and their particular weightings, you see that 24% of the entire portfolio's allocation is dedicated to just the top 6 companies within that entire portfolio, those being Apple, Microsoft, Amazon, Google, Tesla, and Facebook. This means if you invest $100 into this ETF, 24 of those dollars are going to be allocated to just the top 6 companies. Now, it's important to note it's not necessarily a bad thing that 24% of the money you invest into this ETF is going to the top 6 companies. After all, the reason that's happening is because these companies have performed so well historically. However, it becomes important to consider when you invest in multiple different ETFs. So for example, say on top of owning just a standard ETF that tracks the S&P 500, you also invest in a total stock market ETF, which tracks the entire stock market, right? So on one hand, we have the S&P 500, which has only 500 companies, and then we have a total stock market ETF, which tracks over 3,500 different companies. So we have almost 7 times the exposure by using a total stock market ETF. Now, initially, this seems great, because investing in a total stock market fund not only grants us 7 times more stock exposure, but we also feel that our portfolio is safer and more diversified. However, when we compare the top 6 holdings of the total stock market fund to the S&P 500 ETF, we again find that the top 6 holdings are not only the same, but in the total stock market fund, they again account for roughly 20% of the entire portfolio's value. So what this means is that on the surface, while we might feel like we're more diversified and our portfolio is safer because we own not only the S&P 500, but also a total stock market index fund, in reality, our money in both situations is being allocated in roughly the same proportions to the exact same companies. So it's almost as if we were investing twice in the same ETF. So when it comes to investing, especially within these ETFs, it's always important to look at the holdings and the weightings of those holdings within those specific investment funds. If you own 5 different ETFs, let's say, all of which are granting you some level of broad market exposure, you may find that each ETF has relatively the same holdings at relatively the same weightings. So ultimately, when the market corrects back down and stocks end up crashing, your portfolio is going to fall roughly the same amount as if you just held one of those ETFs, because again, they're all holding roughly the same amount of stocks at roughly the same proportions. So additionally, if you know that about a quarter of the money you invest into an S&P 500 index fund or ETF is going to roughly these top 6 companies, then that may allow you to reconsider whether or not you should buy those particular companies individually on top of owning the ETF. So let's say, for example, you own some shares of an S&P 500 ETF, like VOO, and you want to buy some shares of Apple and Tesla individually, maybe because you enjoy those companies or you have a deep conviction on those companies. So while this isn't necessarily a bad thing to do, it's important to realize that because you already have exposure to these stocks in the S&P 500 ETF, by buying them individually on top of that, what you're really doing is concentrating your portfolio further into those handful of names. Now, this is important because on the surface, it may seem like you're diversifying your portfolio by buying these stocks individually, but again, because you already have that exposure within the S&P ETF, what you're really doing is concentrating that portfolio. So if these stocks were to correct back down, not only would your portfolio drop because you own those companies through the exposure you have in the S&P ETF, but now you own them individually. So your portfolio will fall that much more and you'll suffer that much more losses. Okay, so number 2, understanding why we own something. So we just talked about understanding what we own in regards to the different holdings within our different ETFs. So now let's talk about why do we own a particular investment. So we talked about this in depth in a video, I'll link it right up here, but it all boils down to conviction and having conviction on the companies that you own. So having conviction with the stocks you own ultimately means understanding with a high degree of certainty and confidence why you own a particular investment and the reasoning behind it. So not having that conviction is considered a true portfolio danger because ultimately stocks will begin to crash at some point, and by seeing those stocks crash in your portfolio, you're going to feel an emotional reaction, an emotional pain from those losses. And eventually, after seeing enough losses, you're going to start to ask yourself, well, why do I even own this stock? It's just losing me money every day. What's the point? And when you have that kind of dialogue, that's going to result in you selling the investment because, again, you had no conviction initially when you purchased it. Maybe you heard it from someone on YouTube, maybe you read about it online, but at the end of the day, there was no true reasoning. You had no reason to believe long-term in the company, and thus you had no reason to hold it through that pain. So again, when you have no conviction in the stocks that you purchase, you're ultimately going to end up selling when those stocks do end up declining, causing you to lose money and ultimately feel discouraged about the entire investing process. But again, this shouldn't be the case. Instead, you can protect against this portfolio danger by understanding why you own a particular company and understanding that reasoning and that conviction behind it. And again, this will help you ultimately ride out those market declines and help you make money in the stock market. Okay, so lastly, let's talk about yourself, you. Yes, you, and why you are arguably one of the greatest risks to your own investment performance. So we know that historically, the stock market has been one of the greatest wealth creating machines for the average citizen by consistently buying and holding long-term investments, proving to build wealth and compound over time. So then again, what's the problem? Why aren't more people as successful as they can be in the markets? Well, again, a lot of it comes down to yourself and your own human behaviors, your tendencies and your habits that have an adverse effect on your investment performance. So right now, I'm going to talk about 3 steps you can implement right now to help overcome yourself and become a better investor. So tip number 1, stop looking at your portfolio every day or every week. So investing, as we talked about on this channel, is a long-term process, and building wealth and the creation and compounding of wealth happens over a lifetime. Therefore, the daily, weekly, or even the monthly fluctuations of your portfolio aren't important. But more importantly, seeing those daily fluctuations up and down create a whole lot of unnecessary emotion within you. And as we've said multiple times, all it takes is a couple of days of seeing your portfolio drop down into the red and your natural instincts want to take over and just sell everything to stop the pain from those losses. Obviously, we don't want to be selling based on emotion, so to prevent this, limit the amount of time you spend looking at your portfolio's value. Alright, so tip number 2, stop using Robinhood to invest. So this may or may not apply to you, but if you are using Robinhood, it's important to understand why it can be so devastating to your wealth building process to invest with this brokerage platform. Okay, so to understand why it's so important not to use Robinhood, let's talk about the main way Robinhood makes money, and that's through payments from order flow. So all this means is that when you place a buy or sell transaction on the Robinhood app, what they're doing is rerouting that trade to a third party, which executes that trade on Robinhood's behalf. And as such, that third party pays Robinhood a little commission, a little kickback for the privilege of executing that trade. And as a result, it's in Robinhood's best interest to get you to trade as much as possible because that allows them to make more money. And how does Robinhood get you to trade more? By playing with your emotions. So when you open the app, it's clean, it's bright, it has a beautiful minimalist design. The value updates of your portfolio every single second. The numbers move up and down just like a slot machine you'd see in a casino. It even congratulates you when you buy or sell a stock. There's confetti, it's a party, it's a grand old time. So again, why does Robinhood spend so much time on the user experience of their app? And again, it's specifically to play with your emotions. The more excited you get or the more depressed you get, it increases the likelihood that you're going to want to place a certain trade. And by trading, you're making Robinhood more money. However, if you're anything like the average investor, the more you trade the stocks you own, the more you're likely to end up losing on those investments. So instead, I'd recommend using a more boring investing platform, something like Charles Schwab or Fidelity, even M1 Finance is fantastic. All these platforms have the same functionality that Robinhood has, but they're presented in ways that don't play with your emotions and don't try to increase the likelihood that you'll place a trade. Okay, so tip number 3, stop comparing your investment results. So whether it be today on TV, on CNBC, or online on Reddit on Wall Street Bets, people are constantly boasting and bragging about just how much money they made in the stock market. So a lot of the times by feeling that our returns are inadequate and less than compared to another person's return, could ultimately cause us to invest in riskier stocks and riskier investments in search of those higher returns, which could potentially blow up our entire portfolio and destroy the wealth that we're trying to create. So here it's important to remember that your financial situation is never the same as somebody else's. So by trying to mimic those investments or take on riskier investments may not have even been a smart investment for them, let alone you. So stay away from trying to copy somebody else's investments to try to get those same returns. And also remember, people are very quick to brag and boast about their own investment returns, but people are always less willing to share about those losses that they took along the way. So remember, there are always two sides to every coin. So be sure to stick with your investment philosophy that aligns with your goals and your financial situation. I want to thank you for sticking to the end of the video. If you appreciate the content, and if you're still here, which most people aren't, so if you're still here, go ahead, leave a sub. You're like the top 1% of my viewers. Leave a sub, leave a comment, leave a like, and I will see you in the next one.